3 out of 4 times. And the worst case, 1 out of 4 times break even. That's a pretty good formula, right? All right, now remember, no matter how good your trade entry is, the market will sooner or later go against you. And it will be your ability to recover from a losing trade during market reversals that will determine your level of success. If you don't get this down, you'll never make money trading, period. Doesn't matter how good your entry or how good your exits are, because you'll be forced to take losses from which you will never recover, as most people never do. And those are the facts. Now, we talked about hedging. Hedging is hedging as well as dollar cost averaging. Those are all part of trade recovery. There's an advanced version of hedging which I developed, and I call it the zone recovery. It uses a variable called the zone recovery area, and we'll get into it. I've invented so many different terms, and this is why the software is so difficult for people to really grasp, because it's nothing like they've ever seen. It's a complete 180 degrees from what is commonly accepted as a standard trading practice. There's different terms, different things, different ways of going about it, but I'll tell you this. How many recognize the fact that 98% of the people who trade lose money? Everybody. Now, if that is the case, and those are the facts, it would stand to reason that those people are doing something wrong. Something wrong. Right? So, and what happens when you keep doing the same thing over and over and over again, expecting a different result? Right? So we need to, by just sheer common sense, we have to do something different, because whatever has been done ain't working. Right? All right, zone recovery. It is an advanced form of hedging. Which basically is opening a trade in the opposite direction of the original trade, based on a mathematical formula. And the purpose is to eliminate trading losses altogether. Now, and the idea is to turn virtually every losing trade into a profitable trading sequence. Worst case, break even. So think about it's a crazy concept. I mean, it's crazy. When you're in profit, you take the profit. And when you have a loss, worst case, you break even. When you add up all those pluses and minuses, what do you have at the end of that equation? Big plus, right? Now, it's a lot more difficult to make a profit when you've got a plus, minus, minus, plus, minus, 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 plus, plus, minus, minus. Right? You're going from an account to a smaller account and then a smaller account. Much more difficult to recover losses than it is not to really need to deal with them at all. Don't accept them. All right, so here's the market. Let's not even worry about what the setups are. You know, what the daily bar is, what the hourly bar is, it doesn't matter. Here's the market we want to get in. This is the current price, whatever it is, I can't see that. Now, where do you think this market is going to go? That's the right answer. You don't know. I don't know. Anybody who says that they know is lying. They don't know. Nobody knows. And this is every moment when you trade. You see, it's so, you know, when I see all these manual traders that probably never traded one micro lot in their lifetime, you know, show all these graphs and you enter here and you enter here, you enter here. Yeah, you're doing that with the benefit of a hindsight. But really, every time when we trade, we're like this. We don't know what's coming, right? So let's suppose that we think the market's going up. Well, we're going to have a price target or some kind of a profit target, and let's just call it our long target up here. Call it 150. That's what we want to make, right? And when we enter into when we open a long trade, and the market, in fact, goes up and hits this price, we'll make our money, right? We'll make our profit. That's simple, right? On the other hand, if we entered a short trade and the market went down, we hit our short profit target down here, say 150 pips. If this market reversed and went down, in fact, we were short, price goes down, comes down here, we make our profit.
I know this is an example. 150 pips one way, 150 pips the other way.
Yeah.
Most traders are looking for literally 30, 40, 50 pips.
Right.
Does this matter?
Not for the purposes of the illustration.
What time frame is this?
I'm sorry?
What time frame?
That is irrelevant. It is a daily chart. This is a daily chart, but that's not what is important. What is important is the concept of trade recovery. Now, we'll make money as long as any target gets hit. If we're right. Now, that would be under ideal conditions, but we don't live in a perfect world, and we might want to go up, or we might want for the market to go up, and then, you know, we open a trade, and we hit our target when the price hits 131.00. That's our 150 pips, right? Now, what happens if we don't hit our target? Or what happens if the market reverses the minute we get into the trade? That often happens, right? Then it's just going. Right? What do we do here?
Open up the
So what happens when the market goes against us? Well, in the zone recovery, we have an acceptable drawdown on that trade. In this particular case, again, don't take these numbers literally. This is only to illustrate. We have an acceptable drawdown of 50 pips. It's a temporary drawdown. So at this point, what we would do, we would enter a trade as we approach or as we hit our 50 pip temporary loss on that trade, right? But the size of so this would be almost like a hedge, but the size of that hedge would be 1.4 lots as opposed to 1 lot. In pure hedging, when the market goes against us and we hedge, it would be 1 lot short, 1 lot long, 1 lot long, 1 lot short. With zone recovery, we actually have a larger position once the market passes through the bottom level of, or the bottom boundary of the zone recovery area. So stay with me here. This is just pure math. This long trade is open. That was our original intention, to hit the target, but for whatever reason, market's going down. We entered that trade at 1.4 lots, a short trade. Now, if this target gets hit, 127.50, guess what? We'll make more money on the aggregate position. And here's how. This original trade will be down 200 pips. So let's just add it here. Original trade is one lot times 200 pips equals 200 pips minus. Let's just say. This other trade, short, will be plus 150 pips, 1.4 lots, right? So 1.4 times 150 equals, sure? Now somebody else, minus 200 plus 210 is what? 10. That's plus 10. Most people would probably get out here with a 50 pip loss, and that'd be it for that trade. Now they'd be looking for another opportunity. Maybe they'd win some, but they would lose a lot, and we're back home again. Right? So
first leg is always, or second leg is always 1.4.
No. It depends on what your trade recovery zone is. It depends on what your recovery target is. All those things play a role in this. And I'll tell you how to calculate those. Right? The software actually does it automatically, so you don't have to worry about it. Right? All right. So now, but guess what? If we hit this target, we make money. Or worst case, I call it worst case break even. You basically set your profit. In the software, you set what your trade recovery result should be. Break even, make a little bit, you can set it for whatever you want. But if a trade goes against me, I just want to get out of it and get out of Dodge. And look for the 3 out of 4 good opportunities. This is not this is not how I make money. This is defensive. This is like putting your defense out there. They don't score very often, right? But don't put them out there and see what happens. This is part of a harvester. This is what we call trade recovery, which is an algorithm that is built into a harvester being a sequence of trades whose only purpose is to basically open trades when the opportunity and when the conditions are met and close those with a profit, and also recover when the market goes against it.
Which means that the more money you could actually deposit into your account, the reason the banks do so well is that they have huge chunks of money that they are being able to do multiple.
Well, they carry their losing trades on their balance sheets.
Years, right?
They can do that for years, exactly. They don't have to close a trade, and they're not going to give themselves a margin call either. If they are at a position where they would require a margin call, the Fed will come in and bail them out. Simple. But you don't have that luxury. They want to give you a margin call, because that means somebody else has your money. When you get a margin call, somebody has your money and you are not getting it back. Yes?
Just like if the 1 lot goes up, if you get the target, that's great.
Right?
If 1.4 comes down, hit the target, it's great.
Great.
If I was doing it, it would.
So if the target doesn't get hit, guess what? All right, we'll enter a trade on the top range of the zone recovery area, which is the top range of the zone recovery area is basically the initial entry point. Same spot. We'll enter a trade for another 1 lot. So now, guess what? You've got two lots that are long, and 1.4 lots that are short. Now, when you hit this target, guess what? If you hit it, you've got 2 times 150, that equals plus 300, right? 1, 2, 150, that's 300 pips. But you also have 1.4 lots short, and you'll be 200 pips down. So 1.4 times 200 equals minus 280, right?
Like you said, most people don't look at 30 or 40.
So Joseph,
What is that?
20 minutes.
Actually, I think those are the right numbers.
so if it, every time it comes back to the price, you do an exact size, or is that just also dependent upon your conditions?
Once the strategy is put in place, the software will calculate the exact size and place the trade at the exact spot where that trade needs to be.
So so this example is just saying, in this case, once it came back to 29.50, another trade was taken at the same size, but that's not necessarily the case all the time.
Not necessarily, it is in this situation, but it's not necessarily. If you change the profit target and you change the zone recovery area, those numbers will be completely different. Right?
How do you determine the zone recovery area?
I'll give you a formula for that. Here's the zone recovery area. That's basically, zone recovery area is the allowable or acceptable drawdown on the initial trade. Right? What is acceptable? Well, let's think about it. What would be acceptable? When do you think the market is not coming back or has a tendency to go in the other direction?
Over 100 pips.
Maybe, depends on what pair. I would say on euro dollar, 100 pips would be good. I would say on pound yen, 100 pips wouldn't be enough. As a rule of thumb, I use 1 average daily range as my zone recovery area.
Just 150 a day.
Yeah. Then I've got 100. Because once it goes past 150, I am assuming next day is going to turn. If it goes one whole day against, in the opposite direction, one whole day, then the chances are it will continue running. Because that's where my, 75% prediction kicks in, right? Now, it doesn't have to. I could be wrong, and the market reverses back down again. So guess what? I'm going to enter at the bottom range of the zone recovery area. Now the 1.4. Right? When I hit this target, I've got 2.8 lots short and 2 lots long. I'm going to make 20 pips. I call that break even, but I'm not going to lose. If it doesn't, guess what? I'm entering in here 1.9 lots. Now, how did I figure out 1.9 lots? Because when you've got 3.9, 150 pips plus, and 2.8, 200 pips minus, you're going to be in plus territory again. Now, I usually keep my zone recovery to 4 turns max. I don't want to turn this into a martingale. You know what a martingale is?
Yeah.
If martingale is the oldest gambling strategy, works like this. Let's just say you're playing roulette betting on reds and blacks. So your first bet, it's a sequence of bets or a betting progression. You bet 1 chip. If you lose, you bet 2 chips. You lose, you bet 4 chips. You lose, you bet 8 chips. You lose, you bet 16 until you lose it all. Okay? So I keep this to a maximum of 4 turns, because by the time the market does 200 pips up, down, up, down, up, down, I have other things going on that are taking profits in between here. This simply only recovers this 1 trade. If I have more trades, the chances are I will have independent zone recoveries on those trades as well.
So once it goes to the 4, then you take each trade individually to zone recovery from?
Once it goes through all 4, the chances are you will already have closed these because of all the other trades that the software had placed. See, this is just one of those 5 trades that you have to one side. Now, there's 5 other trades that you have to the other side, which completely opens up your margin again. So you can trade in between and take profits while this has, at this point it has accumulated a bit of a loss. If it doesn't hit. Eventually it's going to hit.
So then at some point you could actually go over that 10% that you've allotted in a case like that, right?
Doesn't really happen very often. Theoretically, anything can happen. Theoretically, anything can happen. But practically, no, because you're going to limit yourself to the number of turns. You're not going to keep doing this.
So then
Here's the other thing that you do. What the software does. Now, understand this is very advanced hedging strategy, and it's virtually impossible to do manually. Particularly when you have more than 1 trade and several different pair, maybe a couple more than 1 pair that you're trading. It is virtually impossible to keep doing this manually. So the software does it automatically.
So after the 4th turn, are you hedging equally and then waiting?
Let me add something else. The way I can have these zone recovery trades set up is that once they get, remember, once you enter this trade, it has to still run, the market still has to run another 150 pips for you to get out, right? To close the sequence. When I am about 100 pips in profit on here, I'm going to lock in that profit on those individual legs. So when the market reverses, I won't have that leg open anymore. I will have taken a little profit, here a little profit, here a little profit, here a little profit. profit there,
Awesome.
That's,
but all along the way,
that's it.
right? So I won't have all those legs open, but when the market reverses back, it will open that leg again. Lock in the profit, and then it is much easier to chip away, because let's just say that this leg, let's just say this leg gets in 120 pip profit. I lock in 10 pips. I trail it to one to where it's 20 pips locked in, and there's a 100 pip gap because I needed room to play. So the market reverses. This trade gets out with a 20 pip profit, and I won't be dragging it all the way up here.
Which means
My sequence will get closed before even this target gets hit. So basically, it just keeps adding. Every little profit gets added. The harvester will be looking at an aggregate profit of maybe 10, 20, or however many pips you specify. Could be zero if all you want is to break even. Right? Now, I actually don't really, with this in place, I could be just throwing darts blindfolded at the wall that halfway to be painted green and halfway red, and whatever I hit, that's the trade I put on. Doesn't matter. I would be correct 50% of the time by just law of averages. Right? And the other half I recover. Obviously, it would take a lot longer to make the same amount of money because time is money. A lot of time would be wasted in recovery. But recovery is not, like I said before, is not designed to be an offensive offense, like a strategy that makes you money. It's defense. It's a defensive mechanism to protect you from losses. Yeah. So you don't have to take losses. Yes.
So while this is going on, you have other things.
Absolutely.
If the market closed anyway.
That's right. Exactly. Because I'm looking for an aggregate profit, let's just say, I'm looking for an aggregate profit of 100 pips. Right? That's my target. I might have made, a little bit here, a little bit there. Let's just say 10, 20, 30, 40. Then I have 5 other trades where I made 10 other pips each. So this thing goes up 10 pips, boom, closed. We've got our 100 pips next. Next sequence starts when the conditions are met. And the recovery only kicks in when it has to. Right? So, this is such a great thing as far as I'm concerned. That you can basically, it doesn't really matter even which direction you trade, because you're going to be right sometimes and the rest will recover. So, there it is. So, it would be, in a perfect world, if this was applied, it would be pretty impossible to lose money if you allow it to work. All right, we're pretty much at the end here. Let me just summarize here. So basically, with the recovery, if we take a long trade and we right, we make money here. If we're wrong, market reverses, we'll enter a short trade, that's our recovery trade. If we're wrong, we make money. If we go short, if we're right, we make money here. If we're wrong, we go long, we make money here, even if we're wrong here. So you make money either way. Now, So when you have the correct 3-step multi-time frame entry setup with a sound recovery technique, you should be taking profit 3 out of 4 times, and in the worst case, 1 out of 4 times you break even. That's a pretty good formula, right? Now, obviously, this is easier said than done when trading manually, particularly with the zone recoveries. But we've got a solution for you.